Matt Decker here with Leveraged Wealth, and today I'm talking about something that is really crucial to understand, especially in today's environment, and that is the math, the actual math behind market losses. So this all started because I received some comments and just some general feedback from both some clients and some people on YouTube where they said, hey, money is not math. Money is money. It's different than math. And I found that hysterical because money absolutely is math. If you want to know how much money you need in order to retire, given a certain standard of living, assuming a certain rate of return, that is a math equation. It's a math problem that has a solution. And money is absolutely math. And so it's really important that we understand the math behind market losses, and that's what we're going to talk about today. So the first thing that we need to understand is that when we talk about math and market losses, there's really two different ways to measure your returns. One is very common and we're all familiar with it, and the other really only applies to dollars. And so let's talk about that. The first one is your average. So this is just your basic arithmetic, right? You take a bunch of numbers, you add them together, and you divide by the total amount of numbers. So if you have, let's say, different returns, you have a positive 10%, then you have a negative 10%, a positive 10%, and then a negative 10%. What's your average? Well, you have 10 minus 10 plus 10 minus 10 divided by 4. That's a 0% average, right? That's your average, 0% average. So a lot of times when I ask the question to prospective clients and I say, hey, if you have $1 million and your 4 years of returns look like this, plus 10%, minus 10%, plus 10%, minus 10%, what's your average rate of return? And most people will sit there for a couple seconds and they'll really quickly come to the realization that I'm not trying to trick them, and they'll say, well, it's a 0% average. And I get that answer probably, 90 times out of 100. 9 times out of 10, people will say that's a 0% average. And that's true. It is a 0% average. But that brings us to the more important metric that should be used when you're talking about rates of returns relative to your dollars. And so when we're talking about rates of return relative to your dollars, what we're really talking about is the geometric mean. And so it works like this. You start with $100,000. And then let's do our exact same exercise. Plus 10% turns into $110,000. That's pretty easy math. Okay, minus 10%, $99,000. Plus 10%, $108,000. Minus 10%. At the end of the day, we're left with $98,000 for an overall rate of return of negative 2%. Now, how in the world is that possible? Your average is 0, but your actual rate of return on your money is negative 2. Plus 10 minus 10 plus 10 minus 10 is a negative 2% internal rate of return. And that's because of this general concept as it relates to money. Losing money hurts more than making money helps. Losing money hurts more than making money helps. Now, that's not an emotional argument. That's not a fear tactic. That's a math argument. The math would tell you that a negative 10% is worse for you than a positive 10% is good for you, right? The dollars are not the same dollars. They're different. Let me illustrate it a different way. Let's say you start with $1 million. You're getting ready to retire. You've saved up $1 million. And let's say that you end up losing 30% in the market. Okay, so a 30% loss. How much money are you going to be left with? Well, that math is pretty easy to do, right? You're going to be left with $700,000. No tricks there. $1 million, 30% loss turns into $700,000. So the way that most people think about the market is they think, okay, well, if I lose 30%, I need to gain 30%. If I lose 30%, I need to gain 30%. And the reality is, if you gained 30% off of 700, you're left with $910,000. You're still underwater from your original $1 million starting point. And this backs up that principle. Losing money hurts more than making money helps you. If you lose 30%, in order to get back to your $1 million, you need to earn 43% on your $700,000 to get back to your $1 million starting point. The more you lose, the more you got to earn back. If you lose 50% of your investment, if your $1 million goes to $500,000, you actually have to get a 100% rate of return on your $500,000 to get back to your $1 million. So this idea, this truth that losing money hurts more than making money helps, that really starts to become an issue the closer that you get to retirement. So generally speaking, there's two phases of your investing life cycle, right? You have your accumulation phase. And then once you get close to retirement, you start to transition from accumulation into distribution. You've accumulated money, and now you're trying to distribute those assets in an efficient manner so that they can rest you the rest of your life. So accumulation phase and your distribution phase. And what this is all really pointing to, and what this is really getting to, the point of this conversation, is that the sequence in which you get your returns really matters once you get into this distribution phase. So let me say that a different way. You can have the same average rate of return as somebody else, but the order in which you get your returns is actually going to matter once you get into this distribution phase, once you start taking money out of your portfolio, once you start living off of your investments. So I've got an example for you. We're going to start with the accumulation phase because I think most people are most familiar with accumulating dollars. And so what I want to point out to you here is that your average rate of return doesn't matter when you're accumulating money because it's going to be the same no matter what. So let's just take a quick look at this. What we have here are two portfolios, okay? So on the left-hand side, we've got a set of returns starting at 5% and ending at negative 25%. And on the right-hand side, we actually have the exact same set of returns, but they're flip-flopped. So we're starting at negative 25 and we're ending at 5. And you can see that these are in the exact same order. They're just mirror images of one another. So what that results in is the exact same average rate of return at the bottom. They're both going to average 6% because it's the same set of numbers. So they're both going to average 6%. And as a result, their $1 million over the exact same time period, given the same set of returns just in reverse order, grows to the exact same amount of money, $4.2 million. It doesn't matter, right? You're accumulating dollars. We're not taking any money out of this portfolio. So if you're not taking any money out of your portfolio, the sequence of your returns does not have an effect on your overall balance when you're comparing the same set of returns just in reverse order, right? It's the same set of returns, it's just a different order. Order doesn't matter if you're not withdrawing money. This is an accumulation type phase. So let's take it one step further. What would happen to these two accounts if we started taking money out? If we transition from an accumulation mindset to a distribution mindset? What happens if we actually factor in the idea of this geometric mean and withdrawing funds, losing money hurts more than making money helps you? All of a sudden, these two scenarios are going to be vastly different. So when we factor in a distribution scenario, we're going to take out $50,000 from each of these accounts. Nothing has changed. We're starting at $1 million in each scenario. The returns are exactly the same. They're just mirror images of one another, flip-flopped. The same average rate of return is identical from portfolio to portfolio. But what you'll notice is now that we're taking out money, the sequence in which you have negative and positive returns really starts to matter. In fact, so much so that $50,000 actually has this right-hand column running out of money about 15 years in. You're actually running out of money even though you have the exact same average rate of return over a 25-year time frame. Meanwhile, on the left-hand side, we're taking out that $50,000. We started at $1 million and we're actually ending at $2.5 million. We have more money than we started with after withdrawing $50,000 a year. On the right-hand side, we take out the same $50,000 a year, but since we sustained losses early on rather than late, we're actually running out of money at age 83. So this sequence of return chart, that's what this is. This sequence of return chart shows you the importance of having what we would refer to as principal protected dollars or having a principal protection plan. If you don't have a bucket of money where, for instance, in these first 3 years, 3 negative years in a row, if you don't have a bucket of money that you can draw from when the market is down, if you are forced to live out of accounts that are experiencing losses, it is nearly impossible to make that up with a rate of return. And that's why this person's running out of dollars. That's why they're running out of money. They don't have an account where they're drawing from when the market is down. That's why we're a huge proponent of cash value life insurance and some forms of annuities, depending on how you use them. We're a huge proponent of those things, not because we think they're better than the market, but because they protect you from this exact reality. So let me wrap this video up by being crystal clear, because there's tons of conflicting advice out there on the internet. I just want to tell you right here, right now, if you're listening to somebody that says you need all or the majority of your money in some form of annuity or life insurance, you're listening to the wrong person. On the flip side, if you're listening to somebody that says you need all or most of your money in the market, you're probably listening to the wrong person. We hear all the time, why would you do this instrument over here when an index fund linked to the S&P with low fees is always going to generate more money? And to us, that's such a juvenile argument because it completely misses the point of sequence of returns and retirement planning. That might be true for accumulation, but it's certainly not true for distribution. So here's a sample breakdown of what a lot of our clients choose to end up with once they go through our principal protection plan. They'll still have something like 40 to 60% of their dollars in the market. That's just going to depend on their personal risk tolerance and how much money they've already accumulated. Because the reality is this market-based account is going to give us the most growth. So it's possible that if you're behind on saving for retirement, you may have to take more risk with your dollars in order to generate enough returns to be able to retire. That could be true. But most people end up with 40 to 60% of their dollars in the market. At the same time, they'll end up with somewhere between 20 to 35% of their money in some form of principal protected market account or principal protected money. So that could be cash value life insurance, that could be CDs, that could be fixed interest accounts, it could be an annuity, and then at the same time, they have some bucket of cash there that's available. It could be as low as 5% of their money up to maybe 15% of their money. That really just depends on if they have some big capital expenditures coming up that they want to reserve more dollars for. Of course, that could be in cash. But the idea is, let's not have the majority of our money in any one bucket. If we have the majority of our money in any one bucket, let's take, for example, if we had 90% of our dollars in some form of principal protected account, chances are we're not going to earn enough interest to outpace inflation and give you enough income in order to sustain that income for retirement. That's quite possible. The same could be true for your cash account. On the flip side, if we have 90% of your dollars in some form of market-linked account, you are in no way protecting yourself from the market not cooperating with your retirement plans. So the idea is to have multiple streams or multiple buckets of income that are doing different things. They're protecting you from market losses. They're protecting you from inflation. They're protecting you from future tax rates. That's why we preach the principal protected plan. And right now, that's why having principally protected money is so important, because when you lose money in the market, and I don't think there's any doubt in very many people's minds that we are going to experience a lot of market volatility moving forward. If you don't have any principally protected money, you are completely at the whim of the market and you have no control over the order of your returns. And if the market doesn't cooperate with your retirement timeline, chances are, without principally protected money, you're going to run out at some point in time. So here's what I'd encourage you to do. If you don't have a principal protection plan, if you don't know what any of this means or sounds like, if almost all your money's in the market, or if you're hearing confusing and conflicting advice on life insurance, investing in the stock market, cash accounts, annuities, you need to go through our Principal Protection Plan course. Here's how it works. It's about a 45-minute webinar that is in 2 different parts, and it goes through how we view retirement, how we view distribution planning, specifically how we protect your money from market fluctuations, from rising tax rates, and from inflation and healthcare expenses. And then it gives you a couple real life examples on what a principal protection plan might look like. So if you don't know how much money you need to retire, or how much money you should be saving, or if you're going to pay more in taxes than you need to, or if you don't even know if you have principally protected money, what you need to do is click on the link in the description below, or you can click on the top of this video. It's going to take you to that 45-minute webinar where you can see our views on what a principal protection plan looks like. And if you like what you see, you can book a call with us and we can walk you through a specific example for you, tailor it for you, and see if this is something that might make some sense for your retirement plan. I'd like to end by saying that retirement doesn't have to be difficult. In fact, it's not that difficult. It's all based around math. There are things that we can control and there are things that we cannot control. One of the things that we can control is how much risk we take and making sure that we understand the ramifications for how we are allocated in terms of being in the market, being out of the market, what losses do to our portfolio, what tax rates do to our portfolio. All those things, it's just a big giant math equation. And whether you love or hate math, that's something that we can help you with. So go to the website to get that Principal Protection Plan webinar. You can click above. You can see it in the link below. Hopefully you'll see that, and then we'll be talking in the near future. Thanks so much.